Welcome to the Wilber and Longenbaugh podcast, where we break down tax, accounting, and financial strategies to help businesses stay compliant, profitable, and prepared.
Right.
So imagine logging into your bank account tomorrow and, well, seeing $50,000 less than you expected, all because some automated software rule has been silently categorizing a recurring liability as revenue for like 6 months.
Oh, yeah, that is a total nightmare scenario.
It really is. Today, we are taking a deep dive into the exact systems that prevent that nightmare. We want to move past the idea of bookkeeping as just this tedious administrative chore and explore how a structured workflow transforms your financial data into a reliable engine for capital allocation and, well, strategic decision-making.
Yeah, and that transformation really starts with realizing that simply syncing your data is not the same as verifying it. I mean, when you connect your bank feeds or your point-of-sale systems and payroll to your accounting software, you are really just moving raw data from one place to another.
Right, so it's basically just a funnel.
Exactly, it's just a funnel. The critical mechanism that makes this data actually trustworthy is active reconciliation. That is your filter.
Okay, but reconciliation usually sounds like, I don't know, just matching numbers on a screen.
Yeah.
If we are looking at this strategically, it's more like a financial TSA checkpoint.
That is a great way to put it. The system is not just a passive water filter catching debris. It actively forces you to pull aside suspicious transactions, interrogate where they came from, and determine if they actually belong in the business operations.
Right, so you're stopping the bad data at the gate.
Exactly. And so when a duplicate charge from a vendor slips through or a deposit fails to clear, that checkpoint forces an immediate investigation.
You resolve the discrepancy right then and there.
Yeah, rather than letting it silently distort your cash flow reporting for months.
But manning that checkpoint takes time, right? Which is like the ultimate friction for any business owner. I mean, the temptation is always going to be, why not just turn off the scanner, let the data pile up, and batch process the whole year in December when, tax season forces the issue?
Oh, man, because messy books are essentially a form of high-interest debt.
Wait, really?
Oh, absolutely. You borrow a little time today by skipping the monthly review, but you pay a massive penalty later.
Like in forensic accounting fees or something.
Exactly. Forensic accounting fees, missed tax deductions, and just deeply flawed strategic decisions. Monthly bookkeeping has to be the absolute baseline. I mean, you just forget why a transaction happened if you wait 10 months.
Give me a concrete example of how that penalty compounds, because a small mistake in February, it shouldn't ruin my entire year.
Well, let's say in February you buy a heavy piece of equipment, but whoever is rushing through the data entry categorizes it as a standard operating expense instead of depreciable asset.
Oh, I see where this is going.
All right, so by December, that single error has artificially tanked your net income on paper. If you are trying to calculate your true EBITDA to secure a business loan or attract an investor in Q4, your numbers look terrible.
Wow. And you have lost all your leverage just because you didn't have a standardized monthly process to catch that asset misclassification when it happened.
Exactly. You need standardized rules that make the books repeatable and readable for anyone.
I understand the stakes, but I have to push back a little on the manual labor involved here, because I am paying a premium every month for modern enterprise-level accounting software.
Sure, most people are.
Right, and it connects to the bank API, and it uses algorithms to auto-categorize my recurring vendor payments. So why am I allocating human capital to double-check an algorithm?
Because the algorithm lacks business context. I mean, your software can see a $5,000 monthly auto draft and efficiently label it a loan payment, but it doesn't know the details.
Right, it doesn't know the actual split.
Exactly. It doesn't know how to split that $5,000 between the principal, which hits your balance sheet, and the interest, which hits your income statement.
Okay.
A human reviewer executing a formal monthly close process does.
Okay, so the monthly close is not just hitting approve on a dashboard. What are the actual mechanics of locking this data down?
It's really about verifying key balances against outside realities to create a firewall. You don't just ask the software what it thinks your accounts receivable is.
You have to actually check it against something real.
Right. You verify those open invoices against client communications to ensure they're actually collectible. You reconcile the accounts, organize the supporting documentation for audit defense, and, well, finalize the financial statements.
That makes total sense.
Verifying these balances monthly ensures that errors from this month don't bleed into the next. Consistency, accuracy, and review are what actually turn raw numbers into a business asset.
It turns abstract numbers into a hardened, factual foundation for running the company. Well, I will leave you with a final thought to ponder. If your business faced a sudden, massive audit tomorrow, or if a competitor walked in with a surprise buyout offer, would the story your books tell be one of complete chaos or total control? Thanks for joining us on the Wilber and Longenbaugh podcast. For more information and practical financial guidance, visit www.mwwcpa.com.